The current investment environment really is marked with two characteristics. One is volatility, and the other, which is quite evident, is the dispersion in asset prices. So, whether you're actually looking across countries or within sectors, what you see is that some countries or sectors are hugely overvalued, whereas others are actually offering relatively good value to investors and really good opportunities. A great example of this is that recently Jeremy Grantham wrote about Tesla in one of his letters and pointed out that the current market cap of Tesla is over $600 billion, which equates to $1.25 million per car sold every year versus $9,000 per car for GM. So those dispersions are huge. The biggest dispersion in the market at the moment, though, is the dispersion between performance of value and growth opportunities.
Growth investing is where investors are focused on the potential earnings growth of a company. So, can that business actually increase its earnings revenue into the future? So, it involves making some assumptions about the growth of that particular business. Value investing, on the other hand, is focused on the actual cash flows a business is actually generating and determining whether or not those cash flows are fairly priced. The dislocation between value and growth at the moment is being caused by a number of reasons. The first is low levels of interest rates. Globally, we have very low, and in some cases, in some countries, negative interest rates. The issue then that causes is that investors that may have traditionally invested in bond markets or term deposits are finding it difficult to actually earn a return. So the low return prospects in those markets is pushing investors into equity markets. As a result, most of the money is actually going towards stocks with higher earnings growth prospects. So in a low interest rate environment, the market is willing to pay up for any business that has potential future earnings growth prospects. The other reason for the dispersion is the COVID sell-off that occurred earlier last year. Value companies tend to be more cyclical in nature, which means that their performance depends on how well the economy is doing. If the economy is growing strongly, the cash flows of these businesses tend to increase. If the economy is shrinking or we're going into a recession, these businesses tend to struggle a little bit more. During the COVID sell-off, value companies were severely punished because of their linkages to the economic cycle. Growth companies were also punished, but what we've seen is that those growth companies now have actually made back those losses and in most cases are trading above their pre-COVID levels, whereas value companies are still significantly below. We know that the cycle between value and growth has occurred continuously throughout history, and it does mean revert over time, which means that growth may outperform for a period, but then value tends to come back. We know that value tends to stage a long-lasting and powerful recovery as soon as the market anticipates the end of an economic slowdown. We believe that the COVID vaccination rollout and economies starting to open back up will actually set the platform for value to actually perform very well into the future. As a contrarian value investor, what we're focused on is actually buying companies for less than the cash flows that they're actually generating. So in other words, can we buy a dollar's worth of assets for 50 cents? Often that means being contrarian in terms of buying assets that the rest of the market is not willing to purchase because they're nervous about the future prospects of those businesses. However, if you've actually done your work and your research and have a thorough understanding of the cash flows that that business can generate, whether or not those cash flows can continue into the future, you can actually pick up assets quite significantly cheap and earn very good investment returns for investors. The COVID sell-off last year enabled us to pick up assets at once in a decade prices. We have picked up some assets in various asset classes that are trading at 2003 prices. It's almost impossible to buy any asset at its absolute low point. However, we buy these assets with a significant margin of safety that allows us to buy cheap assets with a high degree of confidence that we'll be setting up the portfolio for good, solid future returns to assist you in your financial goals. We may experience some short-term volatility in those prices, but over the long term, we believe that you will reap the rewards as an investor.